Taylor, thank you for joining us. You're a fee-only financial advisor. You're on the West Coast. You're in San Diego. I know that you're living here. We are on a cold day in the Southeast. It's, I don't know, 40 degrees today, but it's 80 and sunny in San. Isn't it always sunny in San Diego?
For the most part, it's hard to beat the weather out here, but, once in a while it catches us off guard and it rains and it ruins my golf game, but I really can't complain too much.
That's awesome. So we have a similar background. I started the big wirehouses when I was younger in the business. My first internship ended up it was at a big Wall Street brokerage firm that eventually I ended up working at full time. And then at some point, as I learned the industry, I said, I gotta get out of here, and I want to go to the fee only registered investment advisory, or RIA world.
Yep.
And it sounds like, did you go big brokerage firm and then go RIA first, or did you tell me about your journey there?
Yeah, day one, out of school, 22 years old, somehow I landed a job at one of these, large Wall Street wirehouse firms. They gave me a desk, a cubicle, a phone, a salary, and a sales quota. And, I was pretty excited at 22. And I was just like a sponge. I had just soaked up, every bit of information I could. I talked to every advisor in that office and even outside of the firm, and really just learned as much as possible. And I loved it. And I really just fell in love with the business. I didn't really know much about being a financial advisor. I had this passion for finance. I knew I wanted to do something in finance, but this job just, showed me how much I loved being a financial advisor. So I battled there through 08, 09, ultimately earned the trust of, about 30 or so really amazing families. And it was a great experience. But I started to challenge eventually, some of the things that I was told and I was taught, and it kind of hit me one day sitting in a meeting. The focus was so much on making the firm more money by selling new products, mortgages and banking solutions, and things that I really had no business or formal training to recommend to people. And it just hit me that like these large publicly traded firms have a fiduciary duty to their shareholders, not necessarily their clients. And like, I'm not suggesting that every financial advisor at a large brokerage firm is dishonest or not putting their clients first, but I don't think that's the case. But it's true, like these large publicly traded firms have to focus on making more money for themselves to keep shareholders happy. So long story short, it just didn't sit that well with me. And also both of my grandfathers were business owners. So I had this kind of burning desire to do my own thing. And eventually in 2014, I started my firm, Define Financial, out here in sunny San Diego.
And where do you got? One thing that just struck a chord when you said that, I've said something similar over the years in our industry in general, and I think about wirehouse, which is again what your traditional Wall Street type firms, which again mostly wonderful advisors at those places. I have many great friends at the big firms, UBS and Morgan Stanley, Merrill Lynch, still to this day, who still almost all say at some point they want to be independent and be a fee only RIA, and it's not easy to make the leap to do that, but there's also this drumbeat in the financial media that it's never enough. So all the way from I call her Susie Ormond, all the way down to just in general the wirehouse messaging or annuity companies that are always saying, or life insurance companies, broker terms. $1 million isn't enough. It's not what it used to be. 2 million is not enough. 5 million is not enough. 10 million is not enough. So you're almost never. It's never enough. And part of that is a CYA. Well, you can never run out of money if you keep saving and you never retire. Part of it too is that, to your point, these are publicly traded companies for the most part, and publicly traded companies are in the business to always ever expand. Right. So they're not they're not going to ever message like, I think if you just get here, you're good. So they have this constantly evolving message of they've got to grow every quarter. So it kind of feeds into their conversations, I think, with their base and their client base. So that kind of strikes a chord when you say, the way you operate can is not product oriented. You're not selling anything for a commission. You're really selling your advice. Is that correct?
Right. And on top of that, as a fee-only fiduciary firm, we are legally obligated to put the client first. Our job is to go out there and shop the market and find the best solutions at the best price and, make our clients more money, not necessarily make, us more money. Our fees are transparent. It's very clear what we're paid. And you're right, we're paid for our advice, not transactions or products.
So that would then, Taylor, that you could just kind of describe this, the difference then between a fee-only fiduciary RIA versus a wirehouse, or I don't know why we even call them wirehouses, but think Wall Street firm like traditionally a Merrill Lynch or a Morgan Stanley. And again, I used to be on that side, and for the last 16 years, I've been in the fee-only fiduciary side of the world. But how do you describe the difference?
Yeah, I hate the word fee only. I mean, we just do such a disservice to consumers with these confusing words. Like fee only is like, I only pay fees. Like it's always bothered me. And it's really confusing because there's also this term fee based. And fee based means that sometimes you charge transparent fees and sometimes you sell products for a commission. So fee only really means, like you said, we have a transparent fee that we're charging in return for our advice. So we're not selling a life insurance product and getting a commission for that. A client might pay us a flat fee of, let's say, $10,000 per year, and our job is to just help them. It might be securing life insurance, but we don't necessarily get paid for selling that life insurance. We're already getting paid by the client.
Wait, so do you like the terminology fee only, you said, or you don't like that term?
No, I don't. I don't like the word fee only because I find it really confusing, especially when there's other words out there like fee based. So the word that I use, and I don't know if this is, I use the word commission free. We don't sell anything in return for a commission. So we are a commission free firm. We charge a transparent
by the way, that's
fee.
Genius. I've never heard anybody say that. That's really good. I like that a lot.
Yeah. So, we don't sell anything in return for a commission. You know exactly what you're paying us. The only fee we receive comes directly from our clients. So you just have to be really, really careful out there because there are advisors out there that wear both hats. They'll take that fiduciary hat off and sell you a product, and then they'll put it back on and charge you a transparent fee. So you just have to really, really ask good questions and really understand the compensation models. And again, we've done kind of a disservice to consumers. It's really hard to navigate.
So let's talk about common misconceptions, and maybe I think you've kind of started to dig some of that up with this terminology between fee-based and fee-only, and they kind of sound the same, so people can interchange them, but they are very different. So what do you see as, even on a larger macro level, if someone is listening to your podcast, which I want to talk about that next. I actually really want to talk about your podcast, but for those who are listening to your podcast or here on the Retire Sooner podcast, some people inherently just feel better about having some coaching and having somebody help. Some people are very comfortable doing this on their own. What do you think that the misconceptions are for people that are maybe kind of in that middle zone of thinking, I don't know if I really want to use an advisor or should use an advisor?
Yeah, I'm fully supportive of people doing it themselves. Your traditional DIY investor. In fact, you mentioned my podcast called Stay Wealthy. It's a retirement podcast. Most of our audience is made up of do-it-yourself investors. The analogy I use is, I can mow my own lawn, right? I can go buy a lawnmower and mow my own lawn. I choose not to. I choose to hire somebody because I would rather do something else with that time. I'd rather watch a movie with my kids or take them to the park. I just value my time differently. Some people really enjoy mowing their lawn, and that's totally fine. Right. And I know, you talk a lot about, living a happy retirement. And if in retirement, you just really enjoy managing your own money and managing your financial plan, like I'm the last person that's going to try to convince you that you shouldn't be doing that. If that truly makes you happy, I think that's great. So yeah, I think, I don't know if that's a misconception or not. I think some of the common misconceptions I hear are that, financial advisors only manage investments or that their job is to outsmart or beat the market. or that their fees are too high, or the value doesn't, outweigh the cost. And probably the most common misconception, you can probably validate this as well, is, I have to have a lot of money to work with an advisor. I have to have like a really complex situation, both of which just aren't true. And I think our profession has done an incredible job in recent years proving those misconceptions wrong, especially in the rise of RIAs and different firms getting more specialized.
Well, where do you think people do end up saying, and now it is time? Do you think it's more of a life catalyst, or is it a certain amount where people start to get nervous about, hey, wow, this is a lot of money now? When do you think people do end up making a transition to saying, hey, Taylor, I need some help, and I'd rather just have someone do this in your term, a commission-free way?
I always say, the short answer is I think you'll just know. You'll just know when it's time. Like, I think we need some professional help. That's the short answer. The real answer is you're going to have some sort of a pain point. The pain point might be you're making money for the first time in your life and you don't know what to do with it. Or the pain point could be I'm retiring and I don't know if I have enough money to retire. Or gosh, I just crunched some numbers and I'm gonna have a giant tax problem in retirement and I don't know how to address this. So there's gonna be some sort of a pain point that you don't know the answer to or you don't want to tackle on your own that's gonna drive you to say, I need some professional help.
Yeah, I think so. That's a really good answer. It's kind of when there is this pain point, you almost know it, and you'll look at you and your spouse will kind of talk and say, "Wow, I think we need some help."
Right.
And it's this. So tell me about Stay Wealthy. Tell me, when did you start this? It's a very successful podcast. So tell me how many years you've been doing it. How have you grown it? And tell me your favorite topics that you guys talk about.
Yeah, thanks for asking. I started the podcast about 4 years ago. It's grown pretty significantly recently, only because I just got more and more specific about who my target listener was. It's a successful, diligent retirement saver, kind of over the age of 45. They don't need help budgeting or saving more money. They've done a really great job, and they kind of want to take their financial plan to the next level. They also want to optimize things, specifically optimize things around taxes. So we love tax planning at our firm. Most people have not calculated what we call your total retirement tax bill. That's the amount that you'll pay the IRS from the date you retire until end of life. It's a complicated math problem, so one of the reasons why most people don't do it. But if you do it, you go through that exercise, you'll find out you're going to pay the IRS a lot of money. Mm-hmm. And if you can just be a little bit proactive in retirement and take control of your taxes and pay them at more opportune times, you can make a giant dent in your tax bill. So a lot of what I talk about on the podcast is tax planning, but we also get into, I think this week's episode was on inflation. We'll get into a different investment management. I did a series on investing in bonds and just got really nerdy on investing in bonds. So I've covered a wide array of topics, but it really has grown because it's so specific and it speaks to a certain type of person. Instead of trying to be you brought up Susie Orman, so she's on my mind, like the next Susie Orman, like that's the last thing that I'm going to try to compete with.
Well, God bless you for that. We don't need another Susie Ormond out there. And again, I kind of just poke fun at her. I think she's great at what she does. I think it because I've always advocated that you don't need millions and millions of dollars. Most Americans can retire really comfortably and have financial independence for less than Wall Street will tell you. And she went on this long, really just almost, in my opinion, kind of a media stunt, saying that you needed a bare minimum of $5 million, better off $15 million in order to really think about retiring. And I'm thinking that just eliminated 99.99% of America. Like, how helpful is that? Anyway.
Well, it makes a good headline.
It's all it is. It's media fodder. So it's car accident financial planning headline. So tell me though, I love taxes too, and I love thinking this through. Maybe just a couple of thoughts around what are some of the big things that you like to counsel people on, whether it's maybe the timing of when you do withdrawals, what accounts you use, tax loss selling, or are you talking about taxes as in tax planning? You should live in another state and save taxes that way. Hey, move to Puerto Rico where the capital gain tax is almost nothing. So let's talk a little bit some of your favorite tax topics. I love this stuff too.
Well, it's a good question about moving. So I'll start there. I'll never suggest to a client that they should move states or countries for that matter to save money on taxes. If it's something that would make them happy, if that's something that they truly want to do, we're there to support it. But I would never, suggest that to a client necessarily, unless their retirement plan was in jeopardy or something. It's like, if you don't do this, you can't retire. So I'll just reiterate. I think it's really important to be proactive in tax planning. Like, that's number one. You can't just sit around and wait for the IRS to come knocking on your door, because at age 72, that's what's going to happen. You've got those required minimum distributions, money that's never been taxed. The IRS is going to come knocking on your door saying it's time to pay some taxes. So you'll start to take those withdrawals. Those are taxable, on top of Social Security, which causes Social Security to become taxable. You might also have a pension. It starts to impact Medicare premiums. So you have this collision of events at age 72 that skyrockets your tax bill. And I see people in a higher tax bracket at age 72 than as a working professional. So again, it becomes, how can we be proactive so that we don't tip the IRS and we reduce that tax bill and we just take control over it? So things like, Roth conversions, a very, very common, well-known strategy. But one of our little known favorites that takes it to the next level is for those who are charitably inclined to pair Roth conversions with something like a donor advised fund. And by doing this, you can achieve your charitable goals, which is great, also reduce your tax bill, and also offset the tax bill from the Roth conversion. So we love kind of pairing these things together. You mentioned capital gains, big fans of realizing capital gains at 0%. A lot of people have a gap to fill at the end of the year for that 0% capital gains tax bracket. A lot of people don't do anything with it. So even if it's just a few $1,000s, like, that's just free money to realize capital gains at 0%. Tax efficient investments like ETFs. I think you were getting at asset location. What types of assets do we put in different types of accounts? So, there's so many levers you can pull. I think there's this misconception that you don't have control over your taxes, and it's just not true.
It's one of the most common questions that I get, you probably get too, are different iterations of converting into a Roth because of this tax tsunami that hits at age 72. It's kind of like, you've saved and now all of a sudden you've got a big IRA. You could be forced to be pulling out 50 grand, 100 grand, 200 grand a year in required minimum distribution. So all of a sudden your income shoots up. And there's this natural thought to say, oh, well, let's get all my IRA money into a Roth. It's not that simple, right? It takes time and some planning to really be able to move the meter on that. So how do you guys, and by the way, do you actually do taxes as well? Are you guys are CPAs as well, or not CPAs?
No, we do not file taxes. And we work very, very closely with client CPAs, but we do not file taxes. So, we do tax planning. We know more than enough to be dangerous, but we do have the CPA involved in all these decisions.
Got it. Okay. And then typically what are your kind of rules of thumb around doing some sort of Roth conversion?
The start of the exercise is, what tax bracket are you in right now? Where is it going to be in the future at age 72 and beyond? And is there an opportunity in there to maybe get some money out of those traditional IRAs at a favorable rate? So that's kind of step number one. We call those your gap years, right? Income shuts off, your tax bracket drops, and before age 72, when those tsunami of RMDs hit, what can we do to start taking money out for Roth conversions? Now, you hit on a really key point that it's just not that simple to take money from a traditional IRA and move it to a Roth, because there is a tax bill, and those taxes can't be paid with the amount that you're converting. So if you're converting $100,000 from a traditional to a Roth, that $100,000 has to go to the Roth, meaning you have to have the money outside of those accounts to pay the tax bill. And that's why we always say that cash management becomes really, really important in retirement. We have to manage our cash effectively so that we have the money to pay the taxes on those Roth conversions. If all of your money is in a traditional IRA, your hands are kind of tied sometimes in these situations.
I love your point too about realizing capital gains at zero. I think we all think of, the capital gains tax, it's 15%. But it's a more dynamic tax than that, right? It can go up to 20 plus the net investment income, or it could be zero, which most people don't realize. Maybe just talk through an example of that. That's a really important idea.
Yeah, in 2022, if you're married filing jointly and your taxable income is below like 83,000 and change, $83,000 and change, you'll have some room to realize long-term capital gains at 0%. So, if you bought Apple stock or bought an ETF that has gone up in value and you've held it for longer than 12 months, deeming it long-term, you can fill up that gap. So if you've got less than $83,000 in change in taxable income for the year, again, you're in retirement, income shut down, maybe you're taking Social Security, but still you're well below that number. You can go ahead and sell some of those securities, realize them at 0%, and you can go ahead and buy them right back again, right? It's just, again, like it's just free money staring at you in the face. And so many people don't do anything with that at the end of the year. So we're just always looking at that as just low hanging fruit, come December.
Yeah, it really is we think about financial advisors as that, hey, just help me. I need some help investing. But
right.
these are normal conversations that you would have with a financial advisor about capital gain realization. How do you stay in a low bracket? You can sell about this much in order to get to that before you start to hit the next bracket of capital gain taxes, which will go up which goes from 0 to 15, goes to 20, et cetera. And then you've got this complication of how do you efficiently do a Roth conversion, and you mentioned the donor advised fund. To touch on that too. That again doesn't get a lot of press. Donor advised fund. Tell me of an example of that. How people can use one of these.
Yeah, we love donor advised funds. But really quick, I'll just comment on something you said. Just about the power of this tax planning. Being proactive and taking advantage of these opportunities. Will save clients hundreds of thousands of dollars, if not millions of dollars when done correctly. And, so when you're thinking about paying a financial advisor an annual ongoing fee, you have to remember that, again, sure, managing investments is part of that, but a lot of these strategies and things that we're implementing make a giant, giant dent in your overall financial plan. So, keep that in mind. So donor advised funds, great charitable giving tool, low cost, easy to access, extremely flexible, basically allows you to take, years of charitable giving. Let's say you might give away $10,000 per year every single year for the next 10 years. Like, you're going to give away $10,000 per year. Let's say you have a high income year this year. Maybe you did a Roth conversion and your income spiked. Well, you can take $100,000, put it in a donor advised fund today, get that tax deduction today to help you with your current tax situation. And then you can go ahead and use your donor advised fund to continue giving that $10,000 per year away. So your charitable giving plan stays intact, but you can make this one giant lump sum contribution to charity. You don't have to give the money to charity right away, but it just goes into this charitable account. Get that giant tax deduction today.
All in that year.
In that year. Yep. And then go ahead and give away that money as you see fit. Extremely flexible.
Over time.
Yeah.
By the way, do you use, I know that Fidelity and Schwab both have really good donor advised funds and platforms and technology. Do you have any preferences, or who do you like to use?
Yeah, all of our client investment accounts are held at Fidelity. So Fidelity is our custodian. It makes it really easy to use Fidelity Charitable. It's just a super nice, clean integration there. Fidelity Charitable is also the largest, and I think their fees are the lowest. Don't quote me on that, but pretty darn good donor advised fund option. So we do use Fidelity Charitable.
So speaking of, you've done a lot of education for younger financial advisors. How did you end up doing that? Did you just feel sorry for people starting out, because it's tough?
Yeah.
Gosh, it's so tough to start out.
Yeah, I mean, I'm sure you can relate to this. As a financial advisor, at our core, like, we just love helping people and just giving back. And I struggled a lot in my early years. I reached out to every single person I could just think of. I would cold call other financial advisors. I would cold DM them, just wanting to pick their brain and learn from them. And I just wanted to make that easier on other, up and coming financial advisors. So I've made myself really available to that next generation. I've started some different communities to help them. My phone's open, my email's open. I just really want to help them on their path and maybe avoid some of the mistakes that I made. So it's something I've really enjoyed. In fact, my now partner here at the firm, who became a partner last year, he cold emailed me 6 years ago, wasn't even working in this industry, asking to pick my brain and learn more about being a financial planner. And now he's sitting here as a CFP and a partner of the firm.
That's amazing.
So it's just been just really cool to make myself available to these younger aspiring planners and watch them, join our firm and now become a partner. And so I really do enjoy it.
That actually is pretty awesome. That's a great story. Let's talk about technology for a minute. Within our industry, I know that you're a big fan of using technology within the financial advice industry. It's funny. It's almost like there's parts of our industry that have rocketed it ahead and really leveraged technology, been amazing, versus there's still a lot of the industry that is moving at tortoise-like speed on still using the same applications, the same financial planning software of many years ago. So tell me about some of the tools that you like to use right now.
Yeah, I mean, I'll acknowledge, I think for the most part, a lot of these apps can just be shiny objects, like what are they really going to accomplish for you? So, I would just hesitate before you just go download a bunch of finance apps. Most of our clients have saved a good amount of money. They don't need to count their pennies. They know they're on a good track. But I still think tracking your expenses is really, really important because knowledge is power. You know where your money is going every single month. You can make really informed, educated decisions with your money that way. So one of my favorite tools is YNAB. You need a budget. Now, again, I'm not suggesting you go on a budget, but it's a really powerful tool to help you track your expenses so you know where your money is going. I always say, the output of a financial plan is only as good as the input. And if you don't know how much money you're spending or how much money you need to spend in retirement, the output may not be that accurate. So I think the folks at YNAB have done a really good job. Things like mint.com are also common tools, but you're hit with advertisements and things like that, which is why I typically recommend YNAB. Off the top of my head, I can't think of much else. The good folks at New Retirement, they've got some great retirement planning tools for do-it-yourself investors.
So, it's funny. There was a time when I would see every 5 minutes I'd hear a commercial for Betterment or Wealthfront or one of the Robo-advisor fintech companies. And it's funny. I haven't seen a ad or commercial for any of them for years. What happened with them? Did they get bought up? Are they still their own? They still independent, or what happened to those robo firms?
Well, I'm on record on my podcast about a year ago talking about Roboadvisors because I had some questions from listeners. So I addressed the topic. I think I did a 2-part series on Roboadvisors. And one of my big concerns that I shared with listeners was what's going to happen to these firms in the future? Betterment, Wealthfront, they've raised a lot of money. These founders want an exit at some point, and that exit is to sell or go public. And so that was my concern was, Wealthfront or Betterment selling to a large firm. I mean, look what happened to LearnVest selling to Northwestern Mutual, right?
Right.
That's the last thing those clients expected. Well, a couple of weeks ago, Wealthfront sold to UBS. So here they are, going straight
Did
back
they
to
really? I didn't know that. So big brokerage firm went and bought this fintech do-it-yourself robo firm. Amazing.
Yeah.
Wow.
Yeah. And it's just amazing to watch how they've spun that in the news that goes against everything, they ever said.
Said to begin with, right?
Yeah.
Oh, my goodness.
And, that's just what scares me about some of these platforms. Again, we saw it with LearnVest, E-Trade getting bought by Morgan Stanley. Now UBS.
One that I was fascinated with early on was Motif. I don't know if you remember Motif. They had this great interface of different pictures and thematic investing, and they just did a great job of the interface. And I had a Motif account, and I had a couple different Motif accounts, and I actually thought they would do relatively well. And then I remember getting a letter in the mail. It's like, your Motif account has been transferred to someone who I think actually Motif almost just stopped operating.
I think they did. Yeah.
It went to somebody else, something like iFolio. I can't remember what it was called. And then about a month later, I got another email that said, here's your new password because we've bought whoever had a Motif account. So it went through like 4 ownership changes in like a month or in a couple months. And I'd actually have to look on my phone to see where my damn Motif account is.
Don't even know where your money is.
But yeah, it is interesting that a lot, you heard so much about these firms and then just gone. Or absorbed somewhere else.
Yeah, and now you're a client of Wall Street again.
Yeah, always the gravitation of Wall Street. Well, the one thing though about our industry, the fee-only investment advisory industry, at least that is perhaps paved a new street. It's still big. It's still giant. I mean, Fidelity is giant, right? Schwab is giant, and they're also publicly traded. But they've paved a new, let's call it, corner of town. It's not Wall Street. It's a different way of approaching investing, and I think it is a lot more about independence. It is a lot more about transparency.
Yeah. I mean, here's the deal. If Fidelity pulled a move like Wealthfront did, well, guess what? Like, I can choose a different custodian for my clients. Right. You know, you and I were in this position where we're making decisions for the best interest of our clients. And if we need to move to a different custodian, we will absolutely do that.
So what is your let's go back to, as we wrap up today, your favorite piece of financial advice, particularly to, our base is, so Retire Sooner podcast. The mission here is to help people retire at least 1 year sooner. We want to help 1 million people retire 1 year sooner. When we launched this in 2021, in the early 2021, ironically, it coincided with this great reshuffling of jobs in America, and due to the pandemic and due to people looking at work from home and work from anywhere and just reassessing life, I think something like 3 million people retired more than normal. So I'll attribute maybe a few of them, a handful, to our podcast. But just the world that we lived in, we've had a ton of retirees in the last year or so. But really, the books that I've written and all the research that I've done for the last decade has been, or much of the research has been around the habits of what I call a happy retiree versus unhappy retiree. Talk to me a little bit about your financial advice in that context. So in financial, in enjoyment during retirement, if you were to address a group of investors that wanted to be happy retirees, what would you talk to them about?
Yeah, so when my grandfather was dying, one of the regrets that he shared with us was that he wished he flew first class. And he didn't mean that literally. I'm sure he flew first class, plenty of times in his life. He was a successful business owner. But I think what he meant was just he wished he would have lived life a little bit more. And I'm sure you can attest to this, even for very successful retirement savers, they have a hard time. They've done a great job saving money, but they have a hard time actually spending that money and doing things for themselves. I mean, I had a very successful client of mine ask if they could afford to go on this trip. It's almost laughable knowing what their financial situation is. And so I dedicate a lot of time to giving clients confidence to go and enjoy their life and spend this money that they worked so hard to save. So I don't know if that's the exact answer that you're looking for, but I just really, really, really just over and over and over and over, try to instill that confidence so that they can go and enjoy life, and go and fly first class if that's important to them, or take that big trip, or give that money to charity, whatever it might be. But just too often I see clients pass away with a lot of money left over, and they didn't go on that cruise, and it makes me really sad. And I'm not sure that they lived retirement as happily as they would have hoped.
Yeah, permission to spend.
Yeah.
Permission to spend. And you're right. I see the same thing, Taylor, which is it takes a lot for someone to be so disciplined to be able to accumulate a lot of wealth. It takes a certain kind of person to do that. And they're very good at delayed gratification. They're very good at that, and it becomes part of who they are. And then when it comes time to see the fruits of that labor, it's hard for them to open up. It's hard for them to spend the money, and it's interesting. It's like almost the opposite of what you would think a financial advisor would do. But what you're saying is that we're helping people understand. Look, no matter, you're spending $100,000 a year. If you only spend $100,000 a year, your money's going to probably triple by the time you get to be 90. Unless you want to give a lot of this away, then you need to be spending more money today and living the life that you should be living today with in a less bridled way. So I think it's an amazing point that you make, is that sometimes it's really about the clarity around it's a clarity around financial planning that gives you the opportunity to say, look, you're underspending. That's actually a kind of a fun conversation.
Yeah, I literally tell clients, go grab a nice bottle of wine, this weekend and just sit down and talk. Like, what do we want to do? What do we want our life to look like? What do we want retirement to look like? How do we want to spend this money? Because that is the question, is like, I don't know how to spend all this money. Like, I don't need to fly first class. I don't need to buy a new Tesla every year. So that becomes a question, like, what do we do? And so it sometimes just takes a lot of conversations with your significant other, your spouse, your family to come to that answer.
Yeah, and I think really that's a good actionable step too, is to remind our listeners here on the Retire Sooner podcast. I love Taylor's idea of just sit down over a bottle of wine. That sounds awesome, by the way, particularly on the coast of California where you are, or anywhere you are in the United States, in this wonderful country that we live in. To sit down and intentionally say, look, I was listening to this podcast today, and these guys were talking about the intentionality around what we are going to spend our money on and what are we going to do for the next 30 years, which may be around the corner. It may be 10 or 15 years away. It may be 5 years away. It might be imminent. But I love that conversation a couple times a year. I think it's first of all, it's a fun conversation to have. I think it's probably good transparency for partners to stay on the same page.
Yeah.
And it's good from a financial planning standpoint. And I love that idea.